Applied Digital now holds $16 billion of 15-year AI data center leases. The question: can this shift a crypto hosting business into a durable AI landlord despite leverage and customer concentration? Applied Digital began as Applied Blockchain, providing hosting services for cryptocurrency mining clients. By 2023, it launched the Psi Computing AI Cloud Services segment for GPU-based AI and high-performance computing. For FY 2025, it reported $144.2 million in revenue from continuing operations, entirely from data center hosting. Legacy crypto hosting facilities include approximately 106 megawatts in Jamestown and 180 megawatts in Ellendale, North Dakota. In this hosting model, Applied Digital supplies energized space, power, and cooling to mining clients rather than mining itself. Historically, around 83% of revenue came from crypto mining hosting, with one large client contributing about 62% in FY 2024. Here's the problem. In FY 2025, Applied Digital reclassified its cloud services AI GPU business as discontinued operations, refocusing on AI and HPC data centers and long-term leases. Previously, the Psi Computing Unit secured AI GPU cloud contracts of up to $180 million over 24 months and $460 million over 36 months, plus an agreement with Together AI for up to $75 million. For Q1 FY 2026, total revenue reached $64.2 million for the quarter ended August 31, 2025. Of that $64.2 million, $37.9 million, about 59%, came from data center hosting for cryptocurrency mining customers. The remaining $26.3 million, approximately 41%, was tenant fit-out revenue for building HPC hosting capacity, including work for CoreWeave. In other words, recent revenues still rely on legacy crypto hosting and construction-related services rather than recurring AI lease income. Here's their position. Applied Digital signed 3 long-term CoreWeave leases totaling 400 megawatts at its Polaris Forge 1 AI data center campus. These CoreWeave leases carry anticipated revenue of approximately $11 billion over roughly 15 years, implying about $1.8 million per megawatt per year. A long-term lease with an unnamed U.S. hyperscaler covers 200 megawatts at Polaris Forge 2, with approximately $5 billion in anticipated revenue over about 15 years. The implied average revenue from this hyperscaler lease is roughly $1.67 million per megawatt per year. That hyperscaler also holds a right of first refusal on an additional 800 megawatts of capacity at Polaris Forge 2. Across CoreWeave and the hyperscaler, contracted AI data center revenue backlog is estimated at approximately $16 billion, largely combining the $11 billion and $5 billion leases. Economically, AI lease commitments of 400 megawatts with CoreWeave and 200 megawatts with the hyperscaler sit next to 106 and 180 megawatts of legacy crypto hosting capacity in North Dakota. In other words, Applied Digital's business model is shifting from shorter-term crypto hosting where it supplies power and space to miners toward long-term AI and HPC infrastructure leases. Looking ahead, in Q1 FY 2026, adjusted EBITDA was approximately $0.5 million, reflecting low operating profitability during the AI campus construction phase. To finance its AI data center build-out, Applied Digital issued 9.25% senior notes and 12.75% preferred equity to Macquarie funds at the project level. Management states that long-term AI and HPC leases at Polaris Forge campuses are expected to generate strong net operating income once fully ramped, but that interest expense from leverage will materially affect net income. On the AI side, contracted revenues are currently dominated by CoreWeave with 400 megawatts and the unnamed U.S. hyperscaler with 200 megawatts. Revenue from these CoreWeave and hyperscaler leases will only be recognized as megawatts at Polaris Forge 1 and 2 are brought into service over the multi-year construction schedule. As of Q1 FY 2026, Applied Digital had not yet recognized recurring AI lease revenue from Polaris Forge 1 or 2. Near-term revenue remained dominated by legacy crypto hosting and tenant fit-out services. The trade-off: a $16 billion AI data center lease backlog with 2 counterparties, financed with 9.25% notes and 12.75% preferred equity, sits alongside low current profitability and concentrated legacy crypto hosting revenues.